Hey traders, this is Blake Morrow with Trader Summit. And once again, I have Eric Basmajian from EPB Macro Research. It is good to see you, Eric. How have you been?
Awesome, Blake. How have you been?
In light of everything, I've been doing great, by the way. And I was just going to say, in light of everything that's happening with Russia and the Ukraine and, everything, I completely forgot about you. No, I'm joking about that. But the point is actually a lot of people have really forgot what's happening below the surface of the markets, and everybody's just so laser focused on what's happening with Russia and the Ukraine situation, hoping for a de-escalation. But how about you? What are you looking at in your world? What's changed since the last time we spoke?
Yeah, this happens every time there's a major event or headline that grabs the market. The market then tends to just focus on that big newsy headline, and then whatever happens in the equity market, the bond market, they tend to just attribute it to whatever that big headline is at the moment. And like you said, they forget that despite everything that's going on, there's still a cyclical trend in the economy that's playing out, irrespective of the headlines that are going on. So,
Sure.
the market goes up today, it goes down tomorrow. Bond market goes up today, and every time there's a big event, they say, well, there was an escalation in the war, then there was a de-escalation in the war, then there was an escalation in the war, and this happens over 3, 4, 5 weeks, and then the net effect, you're like, whoa, well, the curve is a lot flatter than it was 6 weeks ago, or commodity prices are higher or lower than they were 6 weeks ago. And when you start to piece these weeks together, they tend to reference the underlying cyclical trend that was going on the entire time.
Yeah.
So in my framework, in my process, I always stay focused on the underlying cyclical trends, and I don't want to say I don't pay attention to the headlines, but it's not the headlines that are the primary driver of the market. They could cause an algorithm to go up and down and go haywire, but we have to remember that there's always a cyclical trend playing out.
Well, that's a great point that you make there, and I think people tend to forget that in the moment when you're dealing with these headlines that are obviously plaguing the market right now. But I can point out a couple of things that I think are significant. Just as a market participant, I mean, I look at yields, and yields are still stubbornly very close to 2%, and I think a lot of people, look at the market and say, well, why isn't the market lower right now? Based on everything that's happening. I mean, so what are you seeing that's really causing this hold up in yields, maybe, or what are you seeing?
So if we just talk about the treasury space for a little bit,
Yeah.
let's talk about the whole curve. So if we stay on the front end of the curve, we see that short end rates, out to 2, 3, 4, 5 years, they're going straight up, right? Parabolic higher based on
Yep.
the expectation that the Fed is going to engage in aggressive tightening. They're
Yeah.
going to raise rates multiple times, and then they're going to engage in balance sheet roll off. And a lot of these purchases are concentrated on the front end of the curve. So these effects tend to be more outsized on the front end of the curve. So on the front end of the curve, we see short end rates going straight higher, 100 basis points year over year, 120, 30 basis points year over year, huge moves. As we get closer to the 10-year, we see that the yields are rising. If we look at like a 6-month trending basis or 6 to 12 month basis, but they're rising a lot less than the front end. So we see a flattening of like the tens versus twos, right? We see a pretty significant flattening of tens versus twos.
Yeah.
But then if we go all the way out to the long end, the 30-year rate, which is the rate that I focus on the most because that's the most economically sensitive, that rate has not made a new high. It hasn't made a new high since March 2021. And this is probably a good spot to share my screen. And this is kind of the chart that I share all the time when I come on the air with you. Can you see this slide here?
I can. Yeah.
Oops. Let me share. I just lost it for a second. I'm sorry.
That's okay.
It'll just take 1 second. Okay, how's that?
Perfect.
Okay, so I always show what I call a coincident index when I come on your show. And just to remind all the viewers, this is not a leading index. This doesn't tell us where we're headed. This just defines the current trend. And this is not opinion based. This is an aggregate basket of income, production, employment, and consumption, what I call the four factors of the economy. And these are, you can see the components in there below. This is industrial production. This is non-farm payrolls. This is real retail sales. These are all of the things that the National Bureau of Economic Research looks at when they date business cycles. So these aren't like cherry-picked data points. These are just the most reliable data points from the four corners of the economy. And what we could see is if the chart extended earlier into 2020, I'm not sure if you could see my cursor here that I'm circling, the growth rate was accelerating. The growth rate was rising all the way until March 2021. And long-term bond yields were rising along with that. And then we got to March 2021 and the growth rate peaked, and the growth rate has been moving pretty swiftly lower since March 2021. And the 30-year bond yield rose in conjunction with growth, peaked in March 2021, and has continued to move lower. Now, the 30-year yield has backed up with short end rates rising and a whole bunch of factors. But what's amazing is that we've thrown rate hikes, quantitative tightening talks, 7.5% inflation. We've thrown all of that at the bond market, and the 30-year yield still has not made a new high relative to March 2021. And you can't even say it's because of the Fed, because the Fed's barely buying anything anymore, and they're not going to be buying anything next month either. So there's this cyclical force in growth that's still moving lower, that's causing sort of a ceiling on the long-term rates. But the short rates are moving higher because of the Fed, and that's causing the really aggressive flattening that we're seeing. This chart is updated as of the January reporting period. So this tick up from 2.9 to 3.8 because of that stronger than expected retail sales report that we had. But I would just remind everybody that when I'm looking at economic data month to month, there's tons of noise, there's tons of chop. We have to stay focused on the cyclical trend. So yes, we had a pop in January on some of the consumption data, but on a cyclical trending basis, it's still moving lower. And then, we could have another hour-long conversation about what the leading indicators are saying, which will tell us where this line's heading. And just to give you, a quick preview, those leading indicators are still heading lower. So I wouldn't expect this index to move higher. So when that index is moving lower, when the growth rate's moving lower, we still have all of the defensive type postures in the market or that outperform, and all of the risky stuff that still starts to underperform. So I'll kick it back to you after that long rant.
Well, no, that's fine. So all the risky stuff is still under pressure. I mean, you look at assets like Bitcoin, if you will, that is obviously weaker. And we're back below 40,000 in Bitcoin, and you can argue, oh, Bitcoin's going to be here forever, it's going away, or whatever your argument is, but it is still viewed as one of the riskier assets to be invested in a cryptocurrency right now, and that's obviously heading lower as well. So a lot of people like to argue, Eric, that the market is not the economy. The market may be a reflection of the economy at some points, but it's not necessarily the economy. Now, stocks have been moving lower. We're below 4,300 on the S&P as I'm writing here. But how as a trader, what's the best way for me to express, a trade in this type of environment? What would your opinion be there to any of your clients?
Yep, that's a good point. So we have to talk about the different markets. There's the equity market, the treasury market, the corporate bond market, and then the FX market being the main one, commodities as well. You're spot on that equities tend to deviate from these cyclical trends more so than the other markets. But I've been coming on your program here for the last several months with this same cyclical downturn call, and the long-term treasury rate, the 30-year rate, has respected that view. So if you're in the treasury space, you'd want to continue to hold long duration. Those long duration bonds have been the best performing spot on the curve as the curve has flattened. Yeah. So that's very consistent with the cyclical outlook. Other things that I've mentioned on your program with this downturn call is that the foreign currency market tends to be pretty reliable with these cyclical trends. In fact, somewhat leading at points. So I don't particularly look at the US dollar versus the other majors like the euro or the yen, but I look at the US dollar versus all of the cyclical or commodity producing currencies like the Chilean peso, Canadian dollar,
Yeah.
Australian dollar, Australian one being a big one. And we see this trend lower in the Aussie dollar that started around the spring. And there's been some whips, there's been some ups, and there's been some downs, but there's a persistent grind lower in the Australian dollar versus the US dollar. I think we're at like maybe 72 cents as of now. We hit maybe a low of around 69, 70. But we're persistently kind of grinding lower over the last 6 to 12 months. So if these trends are going to continue, which I think they are in terms of growth rate, I would still have a bearish bias for things like the Aussie, the Canadian dollar, all of the cyclical currencies. And I would have a bias for the yield curve to continue flattening. And then if I were to go to the equity market, which would be my last place based on these trends because of the reliability, I would have a underweight exposure relative to my baseline or my personal benchmark. And all of my equity exposure would be tilted in the defensive direction. So utilities, staples, my big mega cap technologies. So not, ARC or any of the hyper growth risky type stuff that's speculative, I would say, but your Apples, your Microsofts, those tends to perform better in these growth downturn environments relative to, the story stocks, the meme stocks, whatever you want to call them.
Interesting. You also mentioned commodities. Commodities have been on a tear. Obviously, it's hard to pin your finger on exactly which commodities have been performing better than others. It's like the whole commodity market's been, reflective of a higher inflationary pressure globally. How do you feel about commodities at current levels?
Yeah, that's a really good point. So I separate commodities into a couple of baskets here, and I don't have any charts with me, but I like to look at Commodity Research Bureau puts out great baskets of commodities that tend to give us a viewpoint into things that aren't so easily traded on, popular exchanges. So when we think of commodities, everyone's like copper, oil, and that's really it. And those tend to have really liquid active futures contracts with a lot of speculation.
Yeah.
Commodity Research Bureau puts out a basket of industrials, but in that basket is things like rubber, tallow, hide, wool tops, things that no one really speculates on, but that have strong industrial uses. And when you look at the growth rate of those commodities, so the price growth, we were seeing that back in March, price growth of these commodities was rising at about a 50% annualized rate. That price growth has come down to about a 9% annualized growth rate. So the price growth is coming down quite significantly. And some of these industrials have sort of flattened out. Copper hasn't really gone anywhere in quite some time. There's been some ups and there's been some downs, but it's been pretty much trendless for the last year. The real spikes are happening, at least from the baskets that I'm seeing. The spikes are very concentrated in oil and then some particular foodstuffs. But what I look at when I'm looking at baskets of industrials is the signal on growth. And the industrials broadly have started to flatten out, and the growth rate has started to come down. So that to me is consistent with the cyclical slowdown, but we have some idiosyncratic issues with oil specifically, and then some foodstuffs, which is continuing to rise, which is sort of exacerbating the inflation, and in the worst way possible, because food and fuel is really what hits the consumer very, very hard.
Yeah. Well, that is the truth, and obviously this whole Russia situation is not helping things with that either. So yeah. let me ask you. We're going into the next month where the market is expecting the Fed to raise rates. So what's your call from here? Do you see the Fed raising rates by a quarter basis point, half basis point? Are you taking cues from all these other Fed members that have been out, running their mouths and in their speaking engagements? How do you feel about the Fed going into this next month?
Yeah, so they're definitely going to raise rates in March, and I think that they're going to end the quantitative easing program, and they're going to start a balance sheet rundown. I don't think they're going to start doing outright sales. They may later in the year if things don't totally fall apart by then. But the Fed tends to do what the market prices in at the time of the meeting. So there was a couple of days, maybe a week or two ago, where the market was pricing in an 85% chance of a 50 basis point hike. And had the meeting been that day, I would have said they were going to hike 50 basis points.
Right.
But that pricing has come down a little bit. So we're back in the area code where 25 is more likely. And I think that the Fed would like to probably do 25 rather than 50, but they won't go against the market. So if the market is going to price in 50, they'll do 50. It's a little unclear, but to me, the most important signal from all of this is what's happening with the yield curve. And the yield curve is continuing to flatten. And I think that the more aggressive the Fed gets, the faster that curve is going to flatten and then invert. And then once the curve inverts, a recession is all but assured.
You almost said guaranteed. I almost caught you.
Almost. But the one thing I really want to emphasize for everybody is that and try to contextualize the Russia-Ukraine event. Rather than focus on the Russia-Ukraine event first and then sort of try and guess what's going to happen, because I don't know what's going to happen. You don't know what's going to happen. Right. We could all guess about the situation. We're not in Putin's head. We're not in Ukraine's head. We don't know what the interests exactly are. We could all follow it with interest. But when the economy is in a cyclical upturn, a shock to the economy is not recessionary, because the economy can shrug off these external shocks. But when the economy is in a cyclical downturn, which we're in now, looking at that chart that I just showed, external shocks can very much be recessionary. In fact, they likely are recessionary. So you have to be mindful of the fact that we have this political event going on and we're in a cyclical downturn. So I wouldn't, short the market and sell the market based on Ukraine. But I would be very mindful that we're in a cyclical downturn and we have a hot political issue that, I don't know if this is going to be a shock. You don't know if it's going to be a shock. All I can tell you is that if it's a shock, we are in a downturn and that creates a potential recessionary pocket. Now we also have the Federal Reserve tightening and the yield curve flattening, which creates another potential recessionary pocket. So those are the two things I would be watching. And the third thing I would be watching is what's happening with mortgage rates. So mortgage rates are rising extremely rapidly. About a year ago, we saw 30-year fixed mortgages almost down to 2.5%, 2.6%. We're up over 4% now. So we've had a 150 basis point rise in mortgage rates, which is extremely significant. And the Fed is going to end their program. They're buying, they were buying mortgage-backed securities, which was helping compress the spread between mortgages and treasuries. That spread is rising really rapidly. So if the Fed starts to talk about outright sales and they're going to sell MBS and that spread continues to rise, and we see mortgage rates continue to rise from here, 425, 450, we really got to watch this housing market, because housing is a very important cyclical component of the economy. It's a very big multiplier. You buy a house, there's commodities associated with it. There's a lot of labor. You have to refurnish the house. There's furniture, there's building material. I mean, there's a lot that goes into housing as a cyclical part of the economy. Yeah. So the three things I'd be watching is the Russia event contextualized with the cyclical downturn, the Fed tightening with the yield curve, and then what's happening with mortgage rates. And how I'd be playing that with those risks is a highly defensive posture.
Oh, well, that makes a lot of sense to me. And I'll tell you, I'm in a real estate hot, location, as you're familiar with, being very familiar with the Florida and, northern US real estate markets. A lot of people like to argue that the real estate market's basically untouchable and it's resilient because of the lending, and lending standards are different now versus where they were. But and there's been a lot of shifts from COVID and people working from home. But I guess we might be finding out how resilient the real estate market is, right?
Yeah, you make a really good point, and I won't go on too long. But real estate is very regional. Very regional. So you make an excellent point about that. And I should have mentioned that, where the two biggest things that impact real estate are income and demographics. Income is starting to be impacted, especially real income. So that's going to be a headwind for real estate, broadly speaking. Yeah. And then mortgage rates have risen considerably, which would effectively, be in the income bucket or affordability bucket. So that would be another headwind. Now, there are some states that have terrible demographics in terms of an outflow of people. So that would be a third headwind. But then there are some pockets of the country, like Florida, I think you're in Arizona, that are seeing massive increases in population. So that's a big demographic tailwind. So I can't sit there and say that your specific real estate market is going to be impacted by this, because your demographic tailwind may offset a reduction in income and a rise in mortgage rates. But if you're in a pocket of the country that may have a triple threat of outflowing demographics, lower real income, and higher mortgage rates, that's a potential pocket that would be an area to be, at least cautious of, in my view.
Oh man, now that person that's 100 miles outside of Boise, Idaho, just really doesn't feel so good now. Just kidding, Eric. Hey, you know what? You make some great points though, and I think they're valid, and they are. This information that us as traders and people that are following the economy closely need to really take note of. So let me ask you this: as a trader, I love the way you talk. I love the way you walk the markets. How do I follow you closer if I don't know much about you?
Yep. So I'm pretty active on Twitter. You can follow me at EPB Research, or you can go to epbmacroresearch.com. I post some stuff on my blog. I also put out a monthly and a quarterly report that kind of goes deeper into these trends, leading indicators, things like that. So those are probably the best places to find me. And you could always send me a DM, email Eric at EPB Macro Research. I'm pretty responsive to most people. So
awesome. All right. Well, Eric, guys and gals, you're watching Eric at home or on YouTube. Make sure you give him a big thumbs up. Subscribe to the channel so you don't miss any of the content. And I try to get Eric on as much as possible when I'm not thinking about Russia and Ukraine. So, Eric, thanks for joining us today. I really appreciate you spending the time with the Trader Summit community, and we'll talk soon.
Thanks. Glad to do it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.